This is Order Flow Trading Course Lesson 12, Order Flow Support and Resistance Levels. My name is Michael Baltos. I'm the founder of OrderFlows.com. Before we get started, I need to read through a brief disclaimer. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. CFTC Rules 4.41. Hypothetical or simulated performance results have certain limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors such as lack of liquidity. Simulated trading programs in general are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profit or losses similar to those shown. Okay, let's get started. Order flow support and resistance levels. Most traders do not know how to determine support and resistance levels. They use a high or low that has been touched a couple of times and think that is support and resistance. If that is the case, the market will never trend. It'll just trade from highs to lows and stuck in a range. So, here's a chart. Here's a 5-minute mini chart. And, the first thing people are going to look at is they're going to look more towards the left and determine where support and resistance level is towards the right. So, they'll see the first thing they'll look at is, the highs and lows and sort of determine, say, okay, this high here at 1884 is going to be my resistance level. This low here is going to be my support level. Okay, we never came back down here, so they're going to look here. Okay, well, we touched this level a few times, 1878, that's going to be my new support level. They'll still take this as the resistance level up here, and then when we start coming up here, spending some time here, they'll think, oh, you see, this is resistance. Well, we just spiked up there. Is that really a level or not? It's people, they just sort of eyeball it, and, they think they know what they think they have, solid support and resistance levels, but, if we traded 2 lots up here, is that really going to be resistance if we come back up to it? We spike up here, is this going to be resistance again? You need something more than, just printing a high or a low. So when properly understood, order flow will show you market-generated support and resistance levels. These levels are important during the trading day, especially when the market circles back to those levels. Knowing where buyers are supporting the market, knowing where sellers have supply to sell. Key areas where the market can turn when the area is retested. Not always areas where market is out of balance. It could be an area where market is in balance. Oftentimes it is an area where the market can't move prices past. If the market can't move the price past a certain level, if the market can't move the price above 1940, that's going to be your resistance level. Support and resistance helps guide you in your entries and exits. Support levels can be interpreted as levels where there is strong demand dominated by buyers, and resistance levels can be interpreted as levels where there's strong supply dominated by sellers. Now let's take a look at a quick example here. Now, so the market was in a little bit of a downtrend here, coming down, going down into the low at 1045. Then all of a sudden you see a shift. You can see it in the deltas, negative deltas all the way down. Then you get a positive delta. You get a stacked buying imbalance. So there's aggressive buyers here. The market works its way up, starts to come back down into this area where the aggressive buyers were, and now it's acting. This area, this zone of aggressive buyers, is acting as your support level. It's supporting the market. Every time it sort of comes back down to this level, the second time it bounces off of it and goes higher. This is information that's generated from the market. If you're just using, eyeballing and saying, oh, this low here is the low that's going to be my support level, well, if you're waiting for the market to come back to it, it never came back to it. Whereas if you have a market-generated level, right here at 3046, the market came back down to it. It's more accurate than necessarily just eyeballing certain levels on a chart. So support and resistance levels can change. They can and do change. They are levels where buyers and sellers lurk in the shadows. They're not always going to appear there. The market has to start trading to lure people out. Like, people say the, price is an advertising mechanism. So once price starts trading at a certain level, people come out to defend that area or not defend that area. So when a market is trending and gets to a support or resistance level, it'll work its way to the next support resistance level. Now, there are two schools of thought in regards to support levels. Areas where buyers step in and become aggressive, or an area where buyers are already waiting and absorb all the selling. Both are correct. There's no one exact way of picking a support and resistance levels. There's a lot of different factors that go into support and resistance levels. And as far as resistance levels goes, it's an area where sellers step in and become aggressive, or an area where sellers are already waiting and absorb all the buying. Again, both are correct. These are areas where people are, they have supply to sell, and they're going to cap any market that's rallying with their supply. So here's an example of of the first case where support levels where buyers step in, become aggressive. And, I said we're hanging around here near our low, and you're seeing aggressive buying. Market comes back in. You see more aggressive buying, more aggressive buying. This is your market-generated support level. I mean, it's easy when you have software that will draw zones out based on what's happening in the order flow. So, like in this case, you're seeing the stacked imbalances is causing the support. Now, a key thing to remember, it's called support and resistance level, not support and resistance price. So the market can break through an upside level by a few ticks and then sell off. Or conversely, the market can break through a downside level by a few ticks and rally. Think of it more as a zone as opposed to an exact level. Looking back on the chart, don't think of it as, well, in this case, stacked imbalance. So you're going to have a few price levels. But, there's times where the market can break through by a couple ticks and then rally. It's not just going to be one exact price. Market rarely comes back exactly to a price and then turns. More often it sort of comes back to that area and then turns. So remember that support and resistance levels are market-driven levels. They're part of the market. They're generated by the market. At least they should be generated by the market, by the supply and demand of what's happening in the market. I said if you're just sort of looking at a chart and eyeballing it, off recent highs, recent lows, or maybe where we spent some time, that's not an exact market-generated level. You're just sort of looking at it, and yeah, the market bounced off this level, but you don't know factors behind it. So let's look at a bunch of examples here. So this is crude oil, and first I just want to show you, it doesn't always work. You have to take things in context as support and resistance. So you have this buying imbalance up here, but the next bar we opened up below it. I said if it's going to be a support level, we should be trading above it and come into it, not trade below it and come into it. Again, we have another buying imbalance up here, which would normally act as support, but when we open and close, we're spending all this time in it, most of the time below it. If you're looking for it to be a support level, we should start out above the market rather than below the market, because if you're below the market, instead of being support, you're looking at resistance. Okay, here's an example of a crude, again, where it failed. Like I said, it's not, support and resistance don't always work 100% of the time. They work majority of the time, but there's going to be times where they fail, and gotta go through examples of failures first, so you can at least understand it and and take things into context. So what do you have? Okay, you have the market coming down. You get a selling imbalance here, and we open up below it, which is what you like to see. So you have your level here. We're spending some time below it, but then we start trading back into this level. We go through it, but what you're seeing single prints, here, 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 as we're trading up through the level. So what was resistance before is now appearing to become support. That this is something, it sort of talked about earlier about price rejection. Don't marry yourself to a trade. Don't think, oh, I have this level, I have to be short. The market has to go down. Once it starts showing signs of, reversing, your support level, your resistance level is all of a sudden going to become your support level when you're getting, the order flow confirming it. So you could see, initially this was acting as resistance, but, the mood changed in here. You can see how the delta changed from, negative, negative, negative. Now you're starting to string together positives, and you're getting small prints, single prints in here. So, the market's looking to rally, and this level, which was your resistance, is now your support. Again, this is crude. Crude's a very volatile market, but, it provides a lot of trading opportunities. And, we're sort of going sideways, and then all of a sudden you get the selling imbalance right here, sort of at the edge of the sideways move, and you're thinking, hey, we're going to start to break out. But what happens is we're still inside, we open the next bar inside the zone. If it's going to be a resistance level, we should be trading below it. If we're trading inside of it or above it, it's not a resistance level anymore. You have to take things into context. If anything, once you start spending time above it and you're getting, indications that, the market's going higher, it's no longer resistance, it's more of support. Okay, so this is a 5-year chart. Now, I'm going to get into a little bit more advanced support and resistance. Now, what I'm going to talk about is, point of control. The point of control, I talked earlier lessons about how it's the area in a bar with the most volume. And, once you decide you're in a downtrend or an uptrend, it's going to be your support and resistance levels. So if you're in a downtrend, your point of control is going to be your resistance. And if you're in an uptrend, it's going to be your support. So what do you have here? You're working your way down. Point of control is right here. We traded back up towards it, came off. Point of control right here, traded up to it, came off. Now here's where you have the change. I think it's fairly obvious. You can sort of see it with the price rejections here, the small prints. And, so you say you're not yet convinced that this is a low. Once you start getting up in here, I think it's more obvious. But, first off, the point of control is right here. We came down within a tick of it. Point of control is right here. We came right down to the tick. Point of control is here. We came down within 2 ticks. Point of control is here. We came down within a tick. And then the market closed for the day. But this is market generated information, and it's information you can only get with a volume footprint chart. You're not going to get it on a bar chart. You're not going to get it in a candlestick chart. Oftentimes you just look at a chart and you wonder why the price retraces back down to a certain area in the previous bar and then reacts. You can see why here. It's the point of control. Again, on a downtrend, it's acting as your resistance. We came up within 2 ticks, came up with 1 tick, within 1 tick, within 1 tick. Again, in an uptrend, this is soy meal. People ask, what can I trade? People say, hey, I trade this kind of illiquid market. And soy meal isn't something that a lot of people trade. People are more interested in trading crude oil or mini S&Ps, but soybean oil, it's a product of the soybeans. You crush the soybeans, you get soybean oil, soybean meal, and this is soybean meal. It's a very nice contract, and a lot of commodities are based on supply and demand and hold the order flow theories the same way. So, you're assuming this is your bottom, that you're going to start moving away. So you'll look at the point of controls as being your support. So you got point of control here, came down within 2 ticks, came down again within 2 ticks, within 2 ticks, within 1 tick, within 2 ticks, as the market's moving away. Again, soy meal, same thing. If you're taking this as the beginning of your downtrend, right, you have your divergence, you got your point of control right here, you have your ratio. So, if you're not yet convinced that the move is happening here, you're convinced here. So, the point of control is right here. You got 2 side by side. Yeah, you break through it by a couple ticks. That's fine. It's not exact level sometimes. Sometimes it does overshoot it. Now here's your new level. Came up within 3 ticks. Here's your new level. Came up within a tick. Here it came within 1 tick. Then you see it shift again here. You got the side-by-sides, and now this is becoming your support level. We sort of trade around this PLC here before going up. Okay, this is a bond chart. Again, same thing. This is, it's market-generated information. You're having your uptrend, and you're coming down exactly to the point of control here. Point of control 1 tick. Point of control a couple of ticks. If you're assuming that the market is starting to move, then once you're convinced that you have the shift here, from the uptrend, and now you're going to start a downtrend, you're seeing the single prints here. It's indicating that price up here is being rejected, and you're looking to get short. Look to get short somewhere around the point of controls. I would usually like to give it a couple ticks because it can come up within 2 ticks usually, but it gives you an entry level, and if you're convinced that that's the beginning of the move, your stop can be fairly close. So I mean, you got your point of control right here. Say you're not yet convinced that this is the top. Once you see it here, you're getting short somewhere in this bar. And you get the nice little move down. I should have put. I mean, this is right before the close, so I don't know if it's prudent to start trading there. But what you're going to do is you're going to be looking, to get short around the point of control, and a tight stop just above, the top of the bar at worst case. But you're really going to be looking, just on the other side of the point of control as your stop level. Okay, again, this is the bonds. So, you're starting to work your way up, sort of go sideways. You got these 3 point of controls, lined up here. But it's more bullish than bearish. You got a couple of ratios here. You do have this one, which sort of throws a spanner in the works. But overall, the deltas are positive, and the market is starting to move up. So, this level right here, we come right down to it, get through it by a tick. You can see you got this single print here. Price is being rejected down here. And I'll say it's a no-brainer, but, it's one of those, it's a trade that you're going to have very low risk on if you're getting long in here at, 28, 29. Your stop is just down here around the 26 level, and, and the market goes up. And you can see it's using the point of controls as the support levels on the way up. Okay, back to crude. Crude is kind of a beast sometimes to trade. Let's talk about this real quick. We're sideways here. I'm more inclined to look to get short. We did come up, get stopped out. If you're looking to get short here, usually I put my stop up, just above a few ticks above the point of control, or even at the high of one of the bars. And again, it looks toppy, but what do you have? You got these point of controls here. If anything, this is a sideways market. It's hard really to, I said, if anything, I'm more inclined to get short. But then, I noticed that what's happening is we're starting to, make higher lows on the way up, and it's acting as, and each time as we're making that higher low, it's acting as a support level. Whereas here, you're just sort of going flatline, going sideways. Once you start seeing the point of controls rallying, I'll say rallying, but the point of controls are going higher and higher. I'm always looking to see where, where the bar ends, relative to the point of control before it. And when we're getting in here, I can see, hey, we're starting to reject these prices. I got a single print here, with the ratio. Fairly confident in looking to take a long if we're starting to break out of this area up here. What I was looking for before is this being resistance is now going to be my support. And you can see we just jump right through it here with very thin volume. So what was resistance before is now becoming support. And you can see we're forming the new point of controls well above this earlier level of resistance. Okay, so this is the crude again. Look here, right in the middle. You have, this sort of, it's, point of controls are a little bit higher each level. We're starting to come down here. You get that single print. So, it's telling you this area, when you're first looking at it, you're thinking, well, maybe this is support, but then you're seeing these red candles and you see this single print here, so you're thinking if we can stay below it, then we've got more of a capacity to move lower, and then you get this single print, or sorry, this ratio here, and we staying below this, this sort of what you want to call it, this sort of area here while the point of controls are lined up. We came back up to test it here, and we couldn't, got within a few ticks of it and then sold off. Okay, so this is the E-minis. And what you have here is, okay, you got the rally up here, but then you got right up at the top, you got the point of control, you've got the heavy volume. Heavy volume can act as resistance. If you're looking at a bar chart, you're not necessarily going to know that there's heavy volume up here. When you're looking at a volume footprint chart, you can see that and be fairly confident that the market is going to sell off, especially after you follow up with a single print here. Again, E-minis. And what do you have? You've got, you got point of control side by side, side by side. Really what you're starting to look for is you want to look for when the market is going to start moving away. Even though it's side by side, it still has negative deltas. You want to see the positive deltas start to build up. Like I said, if you're going to start to move away from a low, you're going to need to have positive deltas confirm it. And you're seeing here, you got the positive delta here, here, here. So, once you're starting in this bar, and you get through these areas here, you're going to be looking at, this area here where you want to be, if you're not already long, you should be considering getting long. And, you can tell by the point of controls, we're coming down to the levels acting as support already on your move up. So, the latest to be in the move is sort of, in here or in here, and you can get a few points out of it. Okay, again, this is the E-mini chart, and we have a heavy volume up here. The first time we came up to the high, you have a divergence. You got through the high, but then there's heavy volume stopping it. This is going to be your area of resistance. You got the point of control in this first bar where you have the divergence. When you took out the high, you got the point of control right at the next level, next price level, and you have this heavy volume up here. So you could be, like I say, support and resistance, it's an area, it's a price area, not necessarily one particular price. You can, if you want to, you can go down and try and finesse it to an exact price level, but, most often or not, it's going to be an area, a price area, not necessarily an individual price level. And, and what happens? We just start selling off, like I said, using this area here as your resistance level. The market never came back up. We tried. You see, you can't, there's no follow through, and all you're seeing now is more selling. You're seeing selling imbalances. Here you got a couple, 3 buying imbalances, but we can't get past, it comes right back up to this point of control, this single print here, and then it just continues lower. Like I said, think of support and resistance sometimes as levels, not individual prices. I think people sort of get sidetracked and think of it as an individual price, and if it violates it, it fails. Not necessarily. You have to think of it as a price, a price area. Okay, this is a perfect example. We had come up here, we hit our high here. We got a ratio, got a small print, and then at the bottom of the bar, you've got the selling imbalance. We open up below the selling imbalance, trade back into it, get through to it on the other side. We're still below this point of control. So this is your resistance area. As long as you can sort of stay in this area, preferably below it, then the move will continue lower. But if you're trying to, really pick an individual level and say, okay, the middle of this selling imbalance, is going to be my level, and if we get on the other side of it by a tick or two and we get out, well, you know that you have this level up here, this point of control to hide behind. And, we traded, literally into the middle of the zone, and we tested it again before selling off. This is a mini chart, and, you're seeing the same thing, right? You got the buying imbalance here, just off sort of the swing low. The bar we opened up, outside of the zone, trade back into it. We get on the other side of it by a tick, and then, the support is there. You've seen the buying come back in that occurred here, and the market worked its way back up. Okay, this is the E-mini. This one's a little bit more trickier, but just at a glance, what are you seeing? What stands out? Look at it from this bar to the left. The result is on the right side of the chart. But when you have these point of controls at the same level, you have a ratio up here. Again, the point of control is you came back up towards the ratio, and you couldn't get up to that level or get past it, and then the market sells off. But your first starting point as the resistance level is where all these point of controls are. Your second part is up here at the top where you have the ratio. So anywhere between this high and these point of controls is going to be your your area of resistance. I said it's a resistance area. People get blinded and think it's going to be a single price. Like you think, oh, this is your resistance, and we're on the other side of it by a few ticks. That it's not going to hold. Well, I think it's poor thinking, poor analysis in that respect. I said it's an area, and we came back into the area, and we rejected the prices up here, and we sold off. Again, it's you got the selling imbalance. We spend a lot of time below it. We do come back up into it. We trade just on the other side of the point of control, and continue lower. Now, for me, I prefer to use this selling imbalance, have this zone drawn out. I draw it out 5 spaces. I'm not looking for it to hold, the rest of the day. I'm just using it as a immediate support or resistance level, depending on what type of stacked imbalance you have it. But if after five bars, I really feel it loses its effectiveness. In this case, it did come back, in the 8th bar and tested it and held again. But for the most part, I'm really looking for it to hold over the next 5 bars. For me, I like the move to happen fairly quick rather than, wait out 5, 6, 7, 8, 9, 10 bars. But you see, the same analysis, this is your initial zone, then you'll be looking at the point of control, in worst case up here. So, this bar is going to be your resistance. We came back up into the resistance and got back through it a little bit and then sold off. Once you start trading on the other side of this zone, okay, you could start to, I say worry, but you start to really pay attention and see how price is acting as you get to the point of control or up near the high. Again, this is the point of controls all sort of lined up here, and you got the 2 right off the bat side by side, and then you get this third one here. Just it's 1 bar removed, but what's important is the market tried to rally back up above this point of control, where the 2 bars are, but we couldn't get up to the high, and then we continue lower. So it's telling you that this area in here is going to be your resistance. As long as you can stay below it, then look for that sell-off in the short term. Again, in the sort of the opposite direction, you've got first you're seeing these 2 point of controls here. The market is working its way up. Then you get a red, followed by a green, followed by another green, but still sort of in that area. Then a red and a green. But what's important is you're seeing, initially you're seeing these 2 point of controls at the same level. You do have 2 here, same, roughly the same level. But then, when you form this other bar here where you got 3 in a row, then 4 in a row, but then what you have here is a ratio, a small print ratio is telling you prices below are being rejected. At first you may think, well, I'm inclined to think, it's going to be support because the market is rallying. But, honestly, when you're going sideways, you don't know for sure if it's going to be support or resistance. The market, worked its way up. You like to think it's going to be, pausing and then be a support level, but you don't know. It could very well, turn into a resistance level if the market starts to sell off. You do have a couple of red bars here. Honestly, looking from this bar at 846 to the left, it's hard to tell if it's going to be support or resistance. You want to see the sign, as the market, if it's going to move in which direction. And you see, the first sign here, you see the small print ratio of 59. which is indicating prices down here are being rejected and the market starts to move up. And, so even if you're not looking to get long in this bar, when you have this bar, the next bar at 850, we've broken out of this area. Point of control is much higher. But you're going to be looking now as this point of control here at 1903 as your support area, and if you could be getting along somewhere in there. It didn't pull back as much as you'd like, only got down to 1904, but it continued higher. Okay, this is a 15-minute chart, and 15-minute charts are time-based charts, and usually I look at range charts, but I threw this up here because it's it's one of those things. It's important to note. The same. You look, whether you trade a time-based chart or a range-based chart, you still want to analyze the same things. So the market is working its way down, and then all of a sudden you get this 15-minute chart, right? So you got 4 point of controls right at the same level. Okay, and that's an hour of trading, and the point of control is right at the same level. So I'm inclined to be bearish the market at this point. And use this as my resistance level. And what happens in the next 2 bars over the next 30 minutes? We trade up here and come off. And you're talking 1893 to 1888. That's a 5-point move. That's giving you some solid trading opportunities there. Now, what happens over the next 45 minutes? You get basically 3 point of controls around the same levels. I mean, they're different by a tick at each level. If you average it, it'll be this level, and I don't necessarily like to average, more of a visual average. And what happens is we're staying above this area. So, it's telling you this is your new support area. Because, it would be resistance, I think, if we were trading, below it, trading below 1888 or something. But, the fact is, this bar turned around. This is going to be my next support level, and what was resistance before turns into your support level. Here at 1893, what happens? You get these bars, we trade down to, 1893, 1892, even here, 1893 and a half. So this is a perfect example of, what was initially resistance, later becomes support. And, what's important is when you're breaking these these resistance levels, how it turns into support. Look at what's happening with the volume when you break through this resistance level. You're seeing buying imbalances just on the other side of it, and you're seeing very thin volumes traded on the bid side here. So obviously, people are being aggressive. So, they're saying goodbye to this level as a resistance level. They want to start moving it up higher. And so this resistance level is going to be your new support level. So, anywhere between 93 and 90 would be your, be your new support level. I would look for this to sort of be the bottom of the range. But really this bar at 245 is really the sign that, what was your resistance is now your support level. And you can see it just sort of trades back down into that area and just bounces back up. Again, tests it, bounces back up. So that's the end of lesson 12, order flow, support, and resistance levels. In the next lesson, I'll explain order flow, fair price, and absorption, and how to use them in your trading. People often talk about, market will move from out of balance to a place in balance. So, knowing where the fair price for the market is, where things should be trading, and how to tell when the market is in balance is important to know how to trade around. So thank you. That's the end of lesson 12.